Hi guys, welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. Today I wanted to go to Portfolio Visualizer and back test the Vanguard Total Stock Market Index versus the Vanguard S&P 500 Index. Now I get a lot of questions on which one is better to invest in. Personally, I have both. I prefer the total stock market because I like to have some small caps. But you guys, as you're going to see here, it's very, very close in how they end up. So what we're going to do by this is I'm going to go back to when I started my Roth, which is 2005, you guys. Now, if we look at the historical data here, you can see that in 2005, you could actually only contribute $4,000. And that didn't change up to $5,000 until 2008. But for ease of math, we're just going to go with $5,000 as our initial investment in 2005, and I'm going to say that I invested $5,000 each year into the Roth. Now I realize it's come up since then; it was a little low, but it's going to be close enough, and you'll see. So, our first portfolio is VFIAX, which is the Vanguard 500 Index Admiral shares, the S&P 500. 100% of our portfolio is there. Okay. Secondly, we have VTSAX, which most people know is the Vanguard Total Stock Market Index Admiral shares. And again, 100% of our value is there. So what we've got here is we started in 2005, and I'm doing this to show you a couple things. And we're going to say it ended in 2020. Now, I realize we're 21, but bear with me. So we initially, the first year, put in $5,000, okay? And each year, we contributed another $5,000 once a year. We let it rebalance annually. We reinvested our dividends. We didn't take any money out to my Roth. And I'm saving it for retirement, right? Because I want that tax-free growth. All right, so let's take a look at how we did. I'm going to move myself over here a little bit. So, as we see, 100% stocks in each one. Now, Portfolio 1 is the S&P 500, which is represented by the blue line. And Portfolio 2, which is the Vanguard Total Stock Market Index, is the red line. So if we look at the difference, you guys, when we come down here, you can't really tell a difference. I mean, in the end, it's $4,000. And it actually goes to the Total Stock Market Index over this time frame. Now, if we had adjusted that and put it, say, from 2010 on, I suspect that the S&P 500 would have won. But let's scroll down a little bit more. First of all, initial balance was $5,000. Final balance for Portfolio 1, $280,087. Portfolio 2, again, $284,493. If we look at the best years and the worst years, the best year, the S&P 500 did 32.33%, which is amazing. The worst year was negative 36.97, so almost 37%. If we come down to the second one, total stock market, again, best year, 33.52. So pretty close, you guys, within 0.2%. Worst year, 36.99. So almost identical. 200 difference. Okay? So let's take a look how it did over the years. And you can see over that time frame, we've actually only had 2 down years. 2008, which if you were investing during the Great Recession, I was, it was scary, you guys. It was going down day after day after day and months. It wasn't like last year's little blip. It was pretty scary. The only other year that we really had it down was at the end of 2018, where you see that the S&P 500 lost 4.43 and the total stock market lost 5.17. Other than that, they're all positive. You had a couple of flat years. 2015 and 2011 were both pretty flat and not much happened. But take a look at how these go. Pretty much, they're always within 1 or 2% of each other, you guys. In some years, one's better. Some years, one's worse. And you can see they're pretty darn close. But here's another thing that I wanted you to think about. So our ending balance was $287,000. So I'm going to bring my calculator up really fast here. Let's bring that down here. So remember, we started with $5,000, right? Now we this is over a 15-year time span. So we had 15 total years that we contributed $5,000 for a total of $75,000 that we put into the investments, right? That we put into my Roth. And I'm ending with $280,000 to $284,000. This is the power of time in the markets, you guys. So let's do one more thing. Let's just change the years. Let's say that we didn't get started until 2010. And let's take the Great Recession out of there and see what happens. Now, granted, it's a shorter time frame. Hit the Analyze button. There we go. Okay. So we started with 5,000 in 2010. And currently we are at 150,000 or 151,000. And again, this total stock market has edged out a little bit. But now, you guys, we've only put in $50,000 total, and we have $100,000 in appreciation. That shows you how good the bull market has been over the last decade and a half, 13, 14 years. Again, the 10-year average for the S&P, 13.85, and for the total stock market, 13.78. That's pretty amazing. Now, I want you to realize one thing. What happened in the past is not indicative of what is going to happen in the future. So remember, just because we had such great returns in the past, in the last 15 years, doesn't necessarily mean it's going to be like that forever. Okay, so take that with a grain of salt. But one of the things that I did want to say was the importance of remembering that time is your friend. You saw we put in $50,000 to $75,000 and ended up, well, in 10 years, we added 100,000. But in 15 years, we went from $75,000 put in to over $280,000 with that extra 5 years. Time is your friend. The earlier you can start, even if you're starting with a small amount. I realize for a lot of you guys, maxing out a Roth at $6,000 now is hard. I get it. But if you can put away $100 a month, and maybe you only put $1,200, but the longer that money is in there, the more it's going to grow. All right, you guys, I hope you got something out of this. If you did, do me a favor. Give me that big thumbs up. It really helps the algorithm. If you're not already subscribed, you know the deal. Ring the bell. Hit the red button. You'll get notified each time I make a video. We'll see you. Thanks.